In 2008, the world did not collapse in a single day. It unraveled. At first, it looked like a housing slowdown. Then it looked like a credit problem. Then it became something far more dangerous. It became a crisis of trust. Banks stopped trusting each other. Investors stopped trusting valuations. Consumers stopped trusting stability. And when trust leaves the financial system, liquidity follows. The images are still remembered. Traders staring at red screens. Employees leaving office towers carrying cardboard boxes. News anchors struggling to explain words like derivatives and credit default swaps to a frightened public. The collapse of Lehman Brothers was not just symbolic. It was structural, because when Lehman failed, it revealed a truth few wanted to confront. The global financial system was more fragile than anyone imagined. But here is the part history rarely emphasizes. 2008 did not shrink the system. It expanded it. The response to fragility was scale. The response to collapse was liquidity. The response to fear was intervention. The Federal Reserve cut rates to near zero. Balance sheets exploded. Quantitative easing became normalized. Trillions of dollars flowed into bond markets, equity markets, credit markets. The intention was stabilization, and it worked. The system survived. Markets recovered. But survival came at a cost. Debt did not decrease. It multiplied. Governments borrowed to stimulate. Corporations borrowed to expand. Consumers borrowed to maintain lifestyles in a low-rate world. For more than a decade, the global economy operated in an artificial climate. Money was cheap. Risk felt distant. Volatility was suppressed. Investors learned a dangerous lesson. Central banks will always step in. This belief changed behavior. Why hedge aggressively when liquidity is abundant? Why reduce leverage when refinancing is easy? Why worry about downside when policymakers are watching? The system adapted to permanent support, but support has limits. When inflation returned in the early 2020s, the rules shifted. Interest rates rose, and for the first time in years, the cost of money mattered again. This is where the foundation of 2027 begins. Not with panic, but with pressure. Pressure on corporate refinancing, pressure on government budgets, pressure on commercial real estate, pressure on consumer credit. In 2008, leverage was concentrated primarily in housing and large banks. In 2027, leverage is everywhere. Corporate debt levels relative to GDP are elevated. Sovereign debt has reached historic highs across developed economies. Private credit markets have ballooned in size, operating largely outside traditional regulatory visibility. Passive investment funds control trillions, automatically allocating capital. The financial architecture is no longer just interconnected, it is interdependent, and interdependence increases fragility. If one sector weakens, it transmits stress through multiple channels at once. Consider commercial real estate. Office towers in major cities were once symbols of corporate power. Today, remote and hybrid work have altered demand permanently. Vacancy rates in some regions remain elevated. Property values decline quietly. Loans secured during the low-rate era approach refinancing windows at much higher interest costs. If valuations remain lower than loan balances, defaults rise. Regional banks, which often carry significant exposure to commercial property loans, feel the strain first. In isolation, manageable. In combination with slowing growth, systemic. Now widen the lens. Equity markets are increasingly concentrated in a small group of mega-cap technology firms. These companies dominate indices. Passive funds funnel capital toward them automatically. As long as prices rise, concentration feels efficient. If earnings disappoint or valuations correct sharply, the same passive structures could accelerate decline. Algorithms do not feel panic, they execute it. Liquidity can vanish quickly when selling becomes mechanical. In 2008, social media was not a force. Today, sentiment spreads globally in seconds. A rumor can become a withdrawal. A withdrawal can become a run. Digital banking has removed friction from fear. Confidence once eroded over weeks. Now it can fracture within hours. But perhaps the most important difference between 2008 and 2027 is policy flexibility. In 2008, interest rates were high enough to cut dramatically. Today, rates are already elevated. Cutting too quickly risks reigniting price instability. Keeping rates high risks deepening recession. The margin for error is thin. Fiscal space is narrower too. Government deficits have expanded significantly since 2008. Public debt burdens are heavier. Stimulus packages on the scale of previous crises may face political and market resistance. Bond markets are not passive observers. If investors demand higher yields to compensate for risk, borrowing costs climb further. That creates feedback loops. Higher yields increase debt servicing costs. Higher costs widen deficits. Wider deficits require more borrowing. Confidence becomes the key variable. And confidence is fragile. History suggests that crises often occur when confidence shifts in multiple areas simultaneously. In 2008, it was housing prices falling and bank balance sheets weakening. In 2027, it could be multiple triggers: slowing earnings growth, elevated sovereign borrowing, commercial property distress, private credit illiquidity, geopolitical escalation, currency volatility, none alone catastrophic. Together, destabilizing. The global economy is larger today than it was in 2008. Financial markets are faster. Debt loads are heavier. Policy tools are more constrained. Complexity is greater. Complexity is not strength. It is opacity. And opacity breeds surprise. Consider the shadow banking system. After 2008, regulation tightened around traditional banks, but risk migrated. Capital requirements increased. Stress tests improved resilience, but risk migrated. Private credit funds, hedge funds, and off-balance sheet vehicles expanded. These entities are less transparent, less regulated. In stable environments, they function efficiently. In volatile environments, liquidity can evaporate. If redemptions spike, assets must be sold. Forced selling depresses prices. Depressed prices trigger more redemptions. Chain reaction. Now add geopolitics. The global order in 2008 was still largely cooperative. Today, fragmentation is visible. Trade blocs compete. Sanctions are tools of strategy. Energy markets respond to political shifts. Supply chains are shorter, more regional. Economic shocks transmit through political channels faster. When global coordination weakens, crisis management becomes harder. And then there is psychology. Every crisis resets memory. The generation that experienced 2008 internalized caution. But markets have rallied strongly since. A new wave of investors entered during bull markets. Many have never experienced prolonged systemic downturn. Risk, once again, feels theoretical. Cycles repeat not because data is ignored, but because emotions evolve. Euphoria slowly replaces discipline. Complacency replaces vigilance. The seeds of 2027 are not dramatic. They are gradual. Debt normalizes. Concentration increases, policy dependency deepens, and belief solidifies that modern finance has learned from history. History is not avoided by learning, it is reshaped by behavior. If 2027 becomes worse than 2008, it will be because the system grew faster than its safeguards. 2008 was a crisis of banks. 2027 could be a crisis of structure. If 2008 was a crisis of leverage hidden inside banks, then 2027 could be a crisis of leverage embedded inside everything. Because the modern financial system is no longer built around a single vulnerable sector. It is built around constant motion, constant refinancing, constant liquidity, constant growth assumptions. And when a system depends on constant expansion to remain stable, slowing becomes dangerous. Let's move deeper. In 2008, governments absorbed private sector losses. Public balance sheets became shock absorbers. Stimulus stabilized demand. But what happens when the public balance sheet is already stretched? Sovereign debt levels across major developed economies now stand far higher than they did before the financial crisis. Servicing that debt was manageable when rates were near zero. It becomes heavier when rates normalize. A 1% increase in borrowing costs may not sound dramatic. Across trillions of dollars in obligations, it is seismic. When governments pay more in interest, they have less flexibility elsewhere. Infrastructure, healthcare, defense, social support. Political pressure intensifies. Markets notice. Bond investors are not emotional. They are mathematical. If confidence in fiscal sustainability weakens, yields rise. When yields rise, refinancing becomes more expensive. If deficits widen in response to slowing growth, markets may demand higher premiums. A sovereign funding scare does not need to begin in a large economy. It can start in a smaller one. Contagion spreads through perception. If investors reassess sovereign risk broadly, borrowing costs climb simultaneously. In 2008, private credit froze. In 2027, sovereign credit stress could amplify the shock. And when governments face pressure at the same time as banks, the stabilizing force becomes less reliable. Now, consider corporate America. For over a decade, companies refinanced debt cheaply. Low interest rates made leverage efficient. But as rates rose, refinancing windows narrowed. Companies faced maturity walls. Many used borrowed capital to fund share buybacks, mergers, and expansion. Low interest rates made leverage efficient. But as rates rose, refinancing windows narrowed. If earnings growth slows, margins compress. Credit ratings may decline. Investors may demand higher spreads. Defaults may increase gradually at first, then more rapidly. Private credit markets have grown substantially since 2008. These funds provide loans outside traditional banking. In downturns, liquidity mismatches appear. If investors request redemptions from funds holding illiquid loans, forced asset sales occur. Prices fall. Valuations adjust. The problem is not that private credit exists. The problem is that it has never been stress-tested at full scale during a synchronized global slowdown. Opacity magnifies fear. Fear magnifies withdrawal. Withdrawal magnifies stress. Now shift to the bond market itself. The bond market is larger than the stock market. It finances governments, corporations, and consumers. If volatility in bonds spikes, it transmits stress everywhere. In 2027, bonds could be the epicenter. If long-term yields remain elevated due to inflation risk or fiscal concerns, asset valuations across the board must adjust. Stocks are priced relative to discount rates. Real estate is priced relative to financing costs. Private equity depends on leverage. If the cost of money rises structurally, asset prices may need to recalibrate downward. Gradual adjustments are manageable. Rapid repricing is destabilizing. And rapid repricing becomes more likely in an era of algorithmic trading. Machines respond to signals instantly. They amplify momentum. They do not pause for reflection. Add another layer. Currency markets. The global financial system revolves heavily around the US dollar. The dollar functions as a reserve currency, a trade currency, and a safe haven. But safe havens are safe because of trust. If sovereign debt trajectories become concerning, currency volatility increases. Emerging markets often feel currency stress first. Capital outflows pressure exchange rates. Central banks raise rates. Growth slows. Debt burdens become heavier. A regional crisis can become a global shock. Interconnected fragility. Now, return to equities. Market concentration is a defining feature. A handful of mega-cap tech firms dominate performance. Passive vehicles automatically allocate capital. Artificial intelligence has become the defining narrative. But productivity gains take time. Valuations move faster. If earnings fail to meet exponential expectations, repricing follows. The dot-com era provides precedent. Technology survived. Investors did not. AI correction could be a catalyst. Catalysts matter when dry conditions already exist. Geopolitics adds unpredictability. Energy supply disruptions. Trade restrictions. Strategic competition between major powers. Sanctions affecting capital flows. In 2027, trust is thinner. Consider demographics. Aging populations increase fiscal burdens. Pension systems strain. A smaller workforce supports a larger retired population. Productivity must increase to offset this imbalance. If growth disappoints, debt sustainability compounds. Now combine everything: high sovereign debt, elevated corporate leverage, bond market volatility, private credit opacity, equity concentration, geopolitical fragmentation, demographic pressure, each individually survivable, together, potentially systemic. Crises rarely originate where everyone expects. In 2027, the trigger may emerge from an unexpected intersection. Perhaps a sovereign downgrade, perhaps a private credit freeze. The exact trigger is unknowable. What matters is preparedness. The modern system has improved transparency in some areas. Bank capitalization is stronger. Stress testing is more robust. But risk has migrated, and migration makes detection harder. Shadow banking entities are less transparent. Why could 2027 be worse than 2008? Because the system is larger. Leverage is more widespread. Interconnection is tighter. Speed is faster. Policy space is narrower. Public debt is heavier. Geopolitical trust is thinner. Confidence may be more fragile. The world survived 2008. It adapted. It rebuilt. But survival created new dependencies. Cheap money became expectation. Intervention became assumption. Rising asset prices became baseline. If 2027 delivers a synchronized shock, recovery may require more than liquidity. Recovery may require structural adjustment. Debt restructuring, fiscal reform, market repricing, political compromise. These processes are slower than emergency stimulus, and slower recovery feels more painful. The danger is not collapse in a single day. It is prolonged instability, a grinding recalibration, confidence weakening in stages, markets oscillating violently, policymakers constrained by trade-offs, inflation versus recession, stimulus versus debt sustainability, growth versus currency stability. In 2008, the question was whether banks would survive. In 2027, the question could be whether the financial architecture itself must reset. Resets are not the end of systems. They are transformations. But transformation involves volatility. Transformation involves volatility. And volatility tests social cohesion. The final risk is psychological saturation. If households feel squeezed by inflation, job insecurity, and asset volatility simultaneously, consumer demand contracts. Feedback loops accelerate. If corporate stress intensifies, employment weakens. Feedback loops accelerate. Fear is contagious, confidence is fragile, and the global economy runs on both. 2008 taught the world that collapse is possible. 2027 could test whether resilience has limits, because scale magnifies consequence, because complexity hides weakness, speed amplifies reaction, and because belief that we solved the last crisis can blind systems to the next one. History does not repeat perfectly, it scales. If 2008 was a stress fracture, then 2027 could be a structural realignment. The difference between worse and survivable will depend on timing, coordination, discipline, whether growth can outpace obligation, whether confidence holds long enough for adjustment. No collapse is predetermined. The question will be whether anyone believed them.